that advertised $1,000 instant tax deduction will put a maximum of $470 in your pocket, and the average saving is just $205 a year, according to Treasury modeling cited by the Albanese government and the Parliamentary Budget Office. Most people hear $1,000 and picture an extra grand in their refund. That's not how it works at all. Stick with me, because who wins and who quietly loses depends entirely on one number you already control. Here's the simple version. From the 1st of July 2026, working Australians can claim a standard deduction of up to $1,000 for work-related expenses instead of itemizing every cost, and the ATO has confirmed this is now law. But a deduction doesn't cut your tax dollar for dollar. It only reduces your taxable income. Think of it like a discount voucher that takes a percentage off, not the whole sticker price, and that percentage is your tax rate. The core mechanism is simple arithmetic. Your tax cut equals the deduction multiplied by your marginal tax rate, as Treasury and H&R Block both explain. So for a mid-income earner on roughly a 32.5% rate, a $1,000 deduction is worth about $325 back, not $1,000. Think of it like frequent flyer points. The headline number sounds huge, but what lands in your account depends entirely on the conversion rate. Next, who actually qualifies? You must earn labor income like wages or salary to be eligible, according to the ATO, and it only covers work-related expenses like home office costs, professional subscriptions, or travel. It does not apply if your income comes purely from business or investment sources. Think of it like a staff discount. You have to be on the payroll to use it at all. This policy is deliberately built around one group of people. Labor and the Parliamentary Budget Office say around 5.7 million taxpayers, roughly 39% of all taxpayers, currently claim under $1,000 in work-related deductions, and they're the ones expected to benefit. Think of it like a flat-rate meal deal. It's great value only if you'd normally order less than the set price. So here's who really wins. A worker on $60,000 with only $300 of genuine expenses gets about $98 back today, but claiming the full $1,000 standard deduction gives them around $325, roughly $227 extra, using illustrative Treasury-style rates. Their deduction is now bigger than what they actually spent. Think of it like being reimbursed for a lunch you never even bought. That's the sweet spot the policy targets. Before I get to the catch, hold on to this number. The government estimates the average annual tax relief is just $205 in 2026-27, according to Treasury and Labor, while the maximum, reserved for top bracket earners, is about $420. Think of it like a sale advertised up to 50% off, where most items are barely discounted. If breakdowns like this are useful, subscribe. There's a new one every week. Now for the part most people miss entirely. If you already have $1,000 or more of legitimate work expenses and you claim them, the new deduction doesn't make you a single dollar better off. Your tax position stays exactly the same, according to the ATO and H&R Block. Think of it like a coupon for something you were already buying at full price. All it really saves you is paperwork time. Here's the catch the brochure won't stress. The deduction is optional and capped, so if your real expenses were $2,000 and you take the standard $1,000 anyway, you've left $1,000 of deductible spending on the table. A mid-career worker with $2,500 of genuine expenses who takes the shortcut gives up around $487 in tax saving that single year. Think of it like the express checkout. Faster, but you walk out having left savings behind. And because the words instant and no receipts make it sound automatically better, tax experts warn many employees will skip the comparison entirely. But repeated over a 30-year career, that $487 annual gap for a higher expense worker compounds to roughly $1,410 in lost tax savings. Think of it like a small toll you pay every year and never notice until you total up 3 decades of it. So what does this mean for you? Log into MyGov, link to the ATO's online services, and open your past returns to find your typical work-related deductions. If they're clearly under $1,000, the standard deduction likely helps you, worth an average of around $205 a year per Treasury. Think of it like checking your size before you buy. One quick glance tells you which option actually fits. The smart move is a deliberate choice every year, not a default. Before lodging your 2026-27 return, tally your receipts. If they're under $1,000, take the standard deduction. If they're over, itemize and claim the full amount, as the ATO confirms, and keep claiming donations, union fees, and income protection on top, because the law preserves those regardless of which option you pick. Understanding this one distinction between a deduction and a refund could be worth hundreds a year, or thousands over a career. Next, I'm breaking down exactly how Labor's stacked tax cuts combine with this deduction to reach that $3,110 headline figure, and why most of it isn't the deduction at all. Subscribe so you don't miss it.